Hi guys. Today we will analyze Philip Morris stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The short-term trend is positive, while the long-term trend is still neutral. Strong support levels are around $97 and $89. Next strong support levels are around $85 and $79. Strong resistance level is around $106. Next strong resistance level is around $112. In the last month the stock has been trading between $89 and $102 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 4.6 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 3% per year, for last 5 years. We see that the average profit margin of the stock has been around 26% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 118% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Philip Morris Company: bad, average, and good. First scenario. Philip Morris will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 1%. Future profit margin would be a low, 25%. Future free cash flow to net income rate would be a low, 80%. In this case, the fair value of the stock today would be $75. Second scenario. Philip Morris will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 2%. Future profit margin would be average, 26%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $91. Third scenario. Philip Morris will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 3%. Future profit margin would be high, 27%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $109. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.83. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Philip Morris, analysts forecast growth rate around 3% per year in next 5 years, and future P/E around 18. Again, I will use 3 different scenarios for Philip Morris Company: bad, average, and good. First scenario. Philip Morris will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 1%. Future P/E would be a low, 15. In this case, the fair value of the stock today would be $41. Second scenario. Philip Morris will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 2%. Future PE would be average, 17. In this case, the fair value of the stock today would be $50. Third scenario. Philip Morris will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 3%. Future PE would be high, 19. In this case, the fair value of the stock today would be $61. As you can see, today the stock is overvalued, $101, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some concerns on its financial health. The company has a high debt level. Also, the stock is expected to show a very small growth in revenue in the next 5 years, 3% yearly. Based on that, the stock looks overpriced at the moment. I may consider buying the stock for the dividend, when the stock drops to $80. Company's strengths. Philip Morris International is a multinational tobacco company, with products sold in over 180 countries. It sells cigarettes, other nicotine-containing products, smoke-free products, and related electronic devices and accessories outside the U.S. Philip Morris International was spun off from Altria in 2008. The most recognized and best-selling product of the company is Marlboro. Philip Morris is the world's largest publicly traded tobacco company by volume. The company has ample pricing power to stay ahead of inflation, and to offset secular declines in cigarette unit volumes. Cigarette loyalty tends to be strongest in the highest price segments, and with its positioning skewed to premium brands, Philip Morris is among the best positioned to benefit. The company is turning to alternative tobacco products, and non-tobacco products in the pharmaceutical and consumer health and wellness space to grow its revenues. The company's return on assets of 22% and profit margin of 29% are amongst the best returns of the industry. Risks. The tobacco industry is heavily regulated in most countries, and in some cases has been required to sell cigarettes in plain, unmarked packs. Management has strenuously resisted these restrictions, as it believes that they encourage counterfeit cigarettes, and have no proven benefit to public health. Governments also consistently target the industry through excise taxes, which lower net revenue by approximately 60%, and weigh on profitability. Higher excise taxes also tend to increase the sale of counterfeit cigarettes, lowering overall sales. Cigarette demand tends to be impacted more by high unemployment, than by tax increases or health warnings. Smokers often trade down to lower-priced brands or counterfeit products, when their discretionary income shrinks. The company's second quarter of 2022 results were hit by the strong dollar and the loss of earnings from Russia and Ukraine. The company is experiencing headwinds in its heated tobacco business from patent infringement litigation, and from shortages of the chips needed to manufacture its electronic devices. On a macro basis, the company conducts business outside the U.S., exposing it to substantial currency risk. The company has negative shareholder equity, which is a more serious situation than its high debt level. The new deal to buy Swedish Match will increase the company's debt even more. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 3% on average per year. The earnings per share is expected to grow by 6% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.